Okay, so check all of this out. I've just pulled some great data that you guys are going to love this. This is every single price that the stock market hit each month from January 1871 over in the States. And I've put this all on together on this lovely spreadsheet here. Now that's 1,825 monthly data points, and I'm not exactly sure if I'll use all of them, but by the end of the video, I think you'll see a really interesting lesson about just exactly what is important and what isn't important when it comes to starting investing. For this video, I really want to dig into the question for you about whether or not it really matters when you start investing. And I'm not just talking about if you start investing now or next week. I want to really understand whether how much you earn is going to be important, and then also what might happen if you start investing during the absolute peak of the market, or if you get really lucky and somehow start right at the bottom. The question is, does this really matter, or do we as investors worry about all the wrong things when we really should be focused on some other things that really matter? I think this is important at the moment because the stock market's been pretty cruel for investors for pretty much the whole of 2022 so far. It's been a car crash, if we're honest, but one in super slow motion where we thought, yeah, it's probably going to be bad, but it's all right. People are still spending money, employment was high, and companies were still making money. But then out of the corner of our eye, we're also thinking, yeah, but inflation isn't going away. Someone's got to pay for all that money printing, and the world's not exactly in a good place right now. So anyway, here we are, 20% or 30% down, and many more people even lower if they invested into hype stocks, speculative cryptocurrencies, or even some pretty big safe companies. Now, forgetting all of this for a second and stepping back, does all of this really matter for long-term investors? And that's the key thing here, isn't it? For me personally, and a lot of you out there, we want to invest for the long term. So that means we'll invest our money many times as we get paid or find spare cash over many years. And this brings me on to our first key question. Does it matter what age we start? To answer this question, we need to understand time. Time is probably one of the best weapons an investor has. It grows our wealth and it heals our wallets. It's the single most valuable thing on the planet, and it's always making progress. You can bet that Warren Buffett would swap all of his wealth today to be 21 again in a heartbeat. And you can bet the same pretty much be said for all of the billionaires in the world right now. But why is it so important to our money? I'll show you. Now, for a lot of regular viewers, I'm sure you've seen lots of examples like this, but it's always a great reminder about the power of time on our investments. Let's say we start investing this month, invest £200 or dollars, it really doesn't matter what the currency is in this example, and then we just keep doing the same thing every month for 20 years. Now, we're not going to pretend that we invested into Amazon or Tesla or any other crazy stock like that. We'll just assume that we use an index fund to invest into the whole US market, and then on average, we return, say, 8% every year. After 20 years of getting that money in every single month, come rain or shine, good times and bad times, we end up with £118,789. And the best part of that is we only paid in a total of £48,000. And that's because that's £200 multiplied by the 240 months. So as you can see, more than half of what we ended up with comes from gains in our account, and that's the power of compound interest. As our account gets bigger, the effect of getting 8% back every year just gets better and better. It just takes a while to get there. And in fact, in that example, it's only once you get to years 16 and 17 where you actually have an account where there's more interest inside of it than you've actually put in as a total gain. Pretty nice, isn't it? But I know what you might be saying, that's not a great example, it's not living in the real world. Let's use some real figures. Okay, fine. At least I've got all my handy ones in the Excel sheet I made earlier. So if we had actually started investing 20 years ago until right now today, and done the same thing, so going back to 2002 and sticking in £200 a month until today, the real figures are actually even better than our example before. So check this out. 191,685 is our total, and that's really all because for the past 20 years, even once we take into account the global financial crash, this current year and even other smaller dips, it's been a pretty decent bull run. And yeah, sure, it does help if you start in 2002 when the market had already crashed, but hey, you get the point. But the biggest thing I wanted to highlight was how investing consistently really smooths out all the highs and lows, making your earnings graph here, as you can see, look pretty stable. Now, you still had a pretty horrible time during the global financial crash. You can see here that the worst drawdown you experienced was more than 50%, and you still had to experience losing 37% in a year. But the key thing is, if you stick through all of it, you should come out the other side in much better shape. Alright, this all sounds great, but let's be honest, we don't know the future, and many people have said that there's very little chance of getting these kinds of returns that we've just seen over the past couple of decades. We've had stupidly low interest rates, money printing going on everywhere, and lots of cash has flown into stocks and other assets which have pretty much overinflated their prices. So let's just bring in one of the other points I wanted to tackle. Does our age matter, and does how much we earn matter? In short, this one's going to come down to one of the phrases I say quite a lot of my videos, and that is, it depends. There's no doubt that the earlier you can start investing, the greater your chances to build long-term wealth because you'll be contributing more money over many more years, and you'll have that compounding effect working for you in overdrive. I mean, just think, if you can add an extra 5 years or 10 years to the example that we did earlier, say we can invest for 25 or 30 years rather than 20, we can make a big difference to what we actually end up with. So check this out on screen now. Our 25-year investment would end up with £191,673, and then our 30-year investment gets us to £300,259. And on that last example, of that £300,000, nearly £230,000 of it has come from our gains and compounding interest. Pretty impressive, right? Now, again, that all sounds great if we can start early, but what if we start in our 40s or maybe 50s? Because you could have 19 great years and then a massive market crash where 50% of all of your investments drops in half. And also, if we look back at real world market data, we know that markets, crashes and corrections are all just part of this investing game. Well, that's really a whole nother video in itself, but worth saying that that's when you need to really make sure that you build a really well diversified portfolio that's right for you and matches up to your needs and level of risk too. It might be a good opportunity to consult a professional financial advisor, because that is certainly not me. All I will say is that if you do start earlier, you can just get more rolls of the dice, especially in the event of market crashes and bad things happening to your investments. Even if you get super unlucky and invest at the worst time, and if you'd started in your 20s and suddenly find yourself in a bad situation, you've still got loads of time and pretty much another lifetime's worth of investing to play with. Whereas sure, if you start a lot later, then you get less chances, but you can still be smart and clever with your investments. You just have to deal with the usual risks of being invested in the first place. However, saying that, let's just keep things simple for the sake of the video and just consider, what if we have some really bad luck during our investing journey? What's the worst that has happened before? Well, as you might imagine, over periods of even 20 years, looking back at our lovely data, things haven't always gone smoothly. If we cherry pick Mr. Unlucky and put him up against Mrs. Lucky, there's a big difference to the kind of returns you might expect. The worst 20-year period we have from at least fairly recently was from 1959 to 1979, and that's averaged out at just 6.4% yearly growth. So it's still a win and a positive number, it's just not as impressive when we compare the person with the better luck between March of 1980 and March of 2000, just before the dot-com bubble of course, and that ends up getting you 18% per year on average. As you might guess, that would have produced a huge amount of difference to what you might end up with in cash terms, but it doesn't quite answer this whole question. If we go to the extremes and go really far back, then technically the crash of the 1930s would have been a whole lot worse to invest in. Look back at May of 1930. We've got a stock market price of just 23.94. If we happened to just throw all money in at once, we wouldn't have actually seen a positive number in the account until... Gotta keep scrolling quite a lot here, sorry. Until... there we are. January of 1952. Ouch. Now bear in mind that's being really extreme, but you get the point. Actually investing over a long period of time and consistently has brought out positive results, at least for our fairly modern investors. So this leads us on to the big one. For everyone out there now looking to start investing or worrying about whether or not the market is going to drop further, does it really matter if you start right now, next month, or even just wait until you feel butterflies in your stomach? There's no doubt that the answer here lies with our friend and faithful weapon that we spoke about in the beginning, time. Remember that first example where we invested for the last 20 years from 2002 onwards? Well, let's just say that we started literally right at the top of the dot-com crash. In fact, we'll just say that we started in 1999 because we were so excited by the stock market and we didn't want to miss out. Sounds like 2020 and 2021 vibes to me, right? So our 20-year period is 1999 to 2019. Still the same £200 or dollars invested every month as we get paid, and we're still just using a broad US market index fund to keep things simple. And then in the background, we get on with our life and never check our investments until 20 years later, we open up our account and we see this. So quick recap, remember that our 20-year investor until today who avoided the dot-com crash actually made £191,685 or dollars. Well, just before I show you the result, what do you think it will be? How much impact do you think it will cause? $20,000? $50,000? Or maybe even worse? This is right before a big crash, remember? Surely one of the worst crashes of all time has to have done some major damage, right? Well, here's what they'd be sat on right now. £187,375. So just over 4,000 less than if they completely missed it. So let's just think about that for a second. Why is it so low? Well, it's all down to time and a little bit of timing, I guess. You see, if you got some really bad luck and started investing just before all of the 2022 crash happened, and maybe you put in a bit of a lump sum too, you're probably thinking, just my luck, this is typical. And I know you're out there, guys, and thanks for saying hello in the comments and sharing your own journeys. But remember, if this is just year 1 or 2 of a 20 or 30 year journey, then the amount of money being invested today and their timing will really have less and less effect as time moves on. Even if you've invested 5,000 or even 10,000 or more and saw it get cut in half from right now, will that few £1,000s make a real difference over many decades? It will definitely be painful and feel pretty horrible, and it will test you like nothing has before. But unless you commit to doing this in the long term and throughout the good times and the bad times, then you won't be rewarded with those compounded gains. Now again, like we've said, none of us know the future. We don't know if we're walking into an even greater crash, and we still got more room to grow. We could be heading into a lost decade where nothing really happens and stocks go nowhere. Or we could be heading into another bull run. Who knows? Honestly, anything is possible and we can't control any of that. All we can do is make sure that we find some kind of plan that works for us, work out what we want our portfolio to look like, match that up with our own goals and our own level of risk, and then pretty much just go from there. But one hack we can always use and one tool that will forever work in our favor will be time. And let's never forget the old saying, time in the market beats timing the market. Now, with all of that said, if you're not feeling quite ready to invest yet, if you're brand new and looking for some more help, check out my Investing for Beginners guide here, where I break down everything you need to know. And as well as that, I've got an entire playlist here for beginners on screen now to give you loads more help. Anyway, leave me a like on the way out, subscribe for many more, and as always, happy investing.